Hey RT family, Ryan Reynolds here with Keller Williams Consultants Realty with your March 2023 real estate market update. Well, today, friends, we're going to talk about a few different things than we normally talk about. There's a lot of information in the national news, and I want to kind of equip you with some more information than maybe they talk about in the headlines, and also talk about why we're not necessarily like all of them. So the three things we're going to talk about are one is the home price growth. Okay, so we hear a lot about prices coming down in real estate, and I want to show you where those national headlines are coming from and maybe show you why it might not be our area. The second thing we're going to talk about is our national mortgage delinquency rate. So what that will be is to talk about where are we in terms of like the 2008 crash, how are we comparing to that time, and how is this time different than that time. And the last thing we'll talk about is affordability for homes. And those are some things that are in the news. They're impacting what you're hearing probably most likely. And I want to kind of go into that. So first, I'm on my back porch today because it's such a nice day outside. I'm super looking forward to springtime. And well, let's go ahead and get into it. The first thing we're going to talk about is annual home price growth by CBSA, which is essentially a statistical area that the study uses. Now, this one came from Black Knight Home Price Index. And when you look at this chart, what you're going to see is there are some dramatic price declines. And the national headlines have been talking a lot about price declines. However, what you're not going to see is any of those price declines happening around where we are. In fact, almost all of them are on the West Coast and up into the Seattle area. The worst case would have been Los Angeles, I think is what the area is, down 10.5%. Just north of that, down 10.3%, and then all the way up in like the Seattle area, down 7.5%. There is a little bit of a blip down in the Austin, Texas area, where prices are down about 5.5%. But when you look generally across the board in the eastern side of the United States, everything is green. And so we are located directly in the middle of that green. So when you hear that national home prices are going down by this and that percentage, you really have to dig in and say, where exactly are you talking about? Because it's not going down anywhere by us. In fact, prices are going up. So what is the message you should hear from that? Well, if you were waiting on buying a house or trading up because you're thinking home prices are coming down, they're not coming down here. So you really need to get on that sooner than later. And that's what I want to talk about with the price growth. So the next thing I want to talk about are delinquency rates. And so delinquency rates are something that go up when the economy is bad, which a lot of the headlines would have you believe it is now. The delinquency on mortgages goes up because people can't pay their bills. Inflation's so bad, everything's really high. And I'm going to put this chart up on the screen. What you're going to see here is that the national delinquency rate at the end of January was at 3.38% for the 30-year fixed mortgages. And that is on first mortgages. According to Black Knight again. These statistics, by the way, I found on mortgageratedaily.com. So it's a great website if you're a nerd like me and you want to dig into some of these things. But what does this mean? Well, if you look at this chart historically, you can see back in the 2008-2009 timeframe, we topped out around 10.5%, 11%. And then again in 2020, during the pandemic, it jumped back up to a little under 8%, or right about 8%. And that was because people were told, hey, you don't have to pay your mortgage. And so the delinquency rates went straight up. But then, of course, they came pretty much straight down. And if you look at where we are now, it's maybe hard to see on the screen, but that bottom line that we're really close to, that is the record low delinquency line. And so what that means is that pretty much everybody who has a mortgage or a first mortgage is making those payments. So if you're thinking that that would be something that's going to be happening where people are going to go into foreclosure and all these houses will become available and then the prices will come down, I don't think that's going to happen. That's not what it shows here. In fact, if anything, this is showing that people are paying their bills. The economy is probably better than you think, and likely prices in our area especially are going to keep going up. So that's good news on that front. So the last thing I want to talk about today is the payments income ratio for 30-year fixed rates. And so what this is it's looking at what the payment is for most people compared to the average income. And if you look at this chart, what we're going to see is there's two different lines. There's the payment income ratio on the left axis, which is a percentage, and then on the right-hand side, that's going to be your interest rate for what a 30-year fixed mortgage might be. Now, right now, or I should say, as of today, interest rates are right around 7%. You can sort of see that green line trended up between 6 and 8. And what that has produced is the blue line going up to where it was a little higher, but has come down to 33.2%. So what that means is that people are going to have to take 33.2% of their income to pay for the mortgage. Now that is as high as it has been since 2007-8 when things really topped out. And so what does that tell you? Well, it tells you that maybe the real estate market was sort of peaking in terms of affordability, and that either prices are going to have to level out, or maybe the income of people have to come up to match that. But in any case, they're out of balance. And so when you hear things are a little weird in the real estate market, this is a really good example of what that might be referring to. We're just in an unaffordable time because the prices have gone up pretty quickly, and also the interest rates have gone up pretty quickly. Okay, so I've had a technical issue and the sound cut out, so I'm reshooting this video near the end of the day, so you're going to see the lighting be a little bit different, and you can prove that we're real people and this is not some kind of big massive Hollywood studio. So anyway, my point was going to be that the interesting part is that interest rates are very high, and that affects a lot of buyers. However, the number of cash offers we're seeing in the market is really high also. And so those people don't care necessarily as much about what the interest rates do. And so they're able still to push pricing up. And actually their money, their cash, is losing dollars by the day because the inflation rate is high. And so it's better for them to actually buy a hard asset like a real estate, so they can kind of be a hedge against that inflation. So we've got these buyers with cash who want to buy something so that they can not lose as much money on inflation. But you also have these other buyers who really want to buy something, but their interest rate is going up and it's affecting them. So we've got the battle of these two entities, and that's producing a really strange real estate market. So that's all we have for you today. I appreciate you taking the time to watch to the end. If you have any questions about your specific situation or want to ask anything at all, please reach out. We're here to help, and we'll customize a solution for your specific situation. As always, it's the Ryan Reynolds team, unlimited opportunities and exceptional experiences.